Hello and welcome to Fidelity's Outlook 2020. I'm joined by Steve Ellis, Chief Investment Officer for Fixed Income. Now, Steve, welcome to you.
Thanks.
I've heard you describe 2020, the coming year, as tricky. Why?
Yeah, that's true. I think there's a couple of reasons why the environment could be a bit trickier next year, Richard. I think the first thing is that how do you replicate the kind of returns that we managed to eke out this year with yields falling, spreads tightening? I think the second thing, which is on everyone's mind, is there's very much concerns about liquidity and funds as well. So they're two things we have to really grapple with next year.
And recession is a possible risk there as well, isn't it?
Yeah.
What can central bankers do to mitigate that risk?
Well, it is a risk, but we do think it's still less than 50% risk. We do think that's going to be more of a soft landing in the US economy and elsewhere. What can central banks do? Well, I actually think that central banks are fairly impotent in some ways in what they can do. When you put rates down close to the zero bound, or negative in the case of the ECB, it's very difficult for them to actually have any meaningful impact on the economy. And that's why I think there's going to be more emphasis on fiscal policy next year.
So attention turning to governments for fiscal policy to stimulate economies. But what about inflation? If that comes back, then central banks do have to act, don't they? And in fact, I think you're forecasting that there will be a return to inflation if we have a look at this chart. What's that telling us?
Well, I think inflation, when you look at it, is very much an undervalued asset class in its own right. That we think that inflation expectations are too low, that inflation is actually going to start rearing its head into next year. And we're not talking about huge amounts of in terms of increase in inflation.
And the Fed would ignore it?
Well, I think they have to look over the full cycle. That they will, their 2% is more of an average over the cycle. I think they want to see inflation in the system, but I think you have to be careful what you wish for. Already we're seeing money supply increase, and we're seeing labour markets fairly tight. So I think we could see something of a stagflationary environment next year.
That doesn't sound very encouraging. What else are you keeping an eye on? What about China, for example?
Yeah, well, you always have to keep an eye on China, right? So it's when I look at the global economy, I think the Fed sets the global cost of capital, and I think it's China sets the global rate of growth. So that's what we're looking for with China, is how much growth they can generate. And I guess the big call we have on China is that they will do what is necessary to keep growth around about 6.5%, that they will make sure that fiscal policy is mildly accommodative, that monetary policy is also can actually have a pass through into their economy. So we think that, in fact, we actually quite like China corporate credit right now, because there's always a backstop from the authorities. They will always make sure that growth is actually fairly accommodative.
So China debt, that's one opportunity. Where else would you be looking in the year ahead for some positive things to be buying?
Well, look, I think the backdrop we're looking at here is one where core yields are going to stay low for a protracted period of time. The central banks are going to be very accommodative, maybe even cut interest rates further from here. So, this is an environment, I think, where you're looking for income, you're looking for yield. So if you look at the spectrum of assets that you can buy, the different asset classes, I think one which looks very attractive still is emerging market debt, because you do get that income, you get the yield, and also some diversification as well.
Diversifying away. Okay, well, thank you very much indeed to Steve Ellis. Thank you for watching. Goodbye.